funds, so they are ready to pay more interest in exchange for a short-term fund, the loan for 1 year or less than 1 year, right? So that doesn't mean, this theory, there are different theories like liquidity preference theory and expectation theory of interest rates. So in those theories, some theories suggest that the short term interest is less than the long term, and in theory it is logical. Why? Because the usage for money is for short term, so the interest rate is lower, and here is the usage of money for a long term, so the interest rate is higher. But the expectation theory or liquidity preference theory suggests that if you prefer, short run, if people or the banks, they have more money for short term loan, then the short term interest rate will be lower. If banks, they don't have short term loans, and businesses, they want short term loan, it means there is a shortage, then short term interest rate will be higher. Okay, now the global integration of money market interest rates, and that is money market interest rate among countries tend to be highly correlated over time. What does it mean? It means when the economic conditions are weakened, the corporation, they need liquidity, so their need for liquidity declines. It means they are no longer requiring short-term funds, right? Which means company the country is experiencing the economic downturn, or there is economic condition that is weakened, so the short-term funds, they are not needed by the corporation. So what happened? Demand for short-term funds is going to be declined. So what happened? The interest rate also, the short-term interest rate also going to be declined. So we'll see in our coming slides what would be the interest rate at that time. We're going to have, we will find out through this exchange rate. So recall the discussion of market equilibrium from the economics, then you can find out, then you can just remember what will happen if there's going to be excess demand and if there's going to be excess supply. Okay, so the third one is when economic conditions strengthens. What does it mean? Business is booming, they want to expand the business. It means there is an increase in corporate expansion, and the corporations need additional liquidity to support their expansion. What happened? They are creating demand for short-term funds in order to meet their liquidity. So liquidity means all those commitments that are paid within 1 year. Let's share some light on international credit market. So the companies, multinational companies, they also obtain medium-term funds, which is, for example, 3 to 5 years, through term loans from local financial institutions, or through issuance of notes, for example, debentures or bonds in their local market as well. So loans of 1 year or longer extended by the banks to the multinational company or the government agencies in Europe, they are commonly called as Euro credits or Euro credit loans. So to avoid interest rate risk, and what is that? The risk to the banks, that if we give the money to the borrower, and what happened in future, the interest rates rises, then the banks will say that we lose the opportunity to earn more interest. So this interest rate risk is the risk to the banks that in future they may lose the opportunity to earn higher interest rate because they already lock their money with the borrower. So they use common term, we call that LIBOR, which is London Interbank Offer Rate. So they add some kind of premium in LIBOR, for example LIBOR plus 0.5%. What does it mean? Whatever is issued by the interest rate issued by the London Interbank Offer Rate, we're gonna add 0.5 to this. For example, if LIBOR is 2%, then we would be charging 2.5%. If LIBOR increases 2 to 3, then we will be charging you 3.5%, right? So in that way, if you ask loan for 3 to 5 years, so they link the interest rate that you need to pay, and they link it with the LIBOR plus some kind of amount. And that is also not, they just, you know this 0.5 is not just coming from thin air. They have some kind of mathematical model to find out that what exactly is the risk involved in kind of the in this lending. So they're just going to be adding, so they can add up, they can also add 1.5%, they can add 2%, 3%, LIBOR plus 3%, right? So interest rate is based on LIBOR. So if you are issuing to the a company has different kind of risk as well. So the bank can add different kind of risk. So the international credit markets, the short-term interest rate or the medium interest rate, the medium interest rate, they are linked with the LIBOR, right? And the regulations in the credit market, number one is Single European Act. So again, the objective here is not to memorize all those uh, different kinds of act regulations learned by heart. Now you just need to understand what is like Single European Act and what was that and why it was used. Similarly with the Basel Accord, now there are three kind of extension of Basel Accord agreement, 1, 2 and 3. So I'm just going to give you a little overview here. Only the explanation and concept you are required to understand here. So Single European Act is that the capital can flow freely throughout the Europe. There is no capital restrictions. Banks can offer a wide variety of lending, leasing and security activities in the European Union. So if Greek want to have a loan from Germany, they can directly go to Germany and ask loan in euro, because both of them, the currency is the same euro, so they don't have to pay the spread and all those stuff, all the other cost. So that's why the capital can move freely between the countries of the European countries, among European countries. Similarly, the regulations regarding competition, mergers and taxes are similar throughout the Europe. It improves competition, and the purpose of the European Single Act was that all the European countries, they become as a one country. They act like one country, EU, so that they eliminate competition among themselves and they give tough time to the outside European countries. The fourth point of the Single European Act was that a bank established in any one of the European Union countries, they has the right to expand into any or all other the countries. Capital is moving freely, so the capital providers, institutions, they can also establish anywhere in the European Union countries, and they can satisfy the local needs for like saving or the lending of to the businesses. So in that case, what happened? The credit risk is minimized by the establishment of single European Act. Why? Because all the countries, they are using similar currency. Capital is moving freely, so the credit risk in the market is going down. Wherever you can find the cheapest interest rate, you can ask loan from there. For example, in Greek, if the interest rate is lower and you are in other European country, in Germany, you can ask loan from Greek as well, Cyprus as well. Or if the loan is cheaper in Germany and you want to use it in Greek, so you can also ask loan from Germany and use in Cyprus or Greek as well, right? The Basel Accord agreement is that the bank must maintain capital which is equal to at least 4% of their assets. For this purpose, banks' assets are weighted by risk. So basically, in the Basel Accord agreement, we have it is discussed under separate subject which is called banking and finance, banking institution and finance, financial institution. So we know that asset is equal to liabilities plus owner's equity. But in banking case, the owner equity is very limited or very minimal because all the assets and is equal to mostly liabilities. And what are the liabilities? The deposits. Bank need to pay those deposits to the deposit holders. I save my money with the bank. So for bank it is liability because bank need to pay me the amount whenever I request through debit card, through ATM, or through any kind of transaction, shopping. So the owner equity is very small. So what if bank take excessive risk? Then bank threatens its liabilities. Since these are the people's money, if there is a huge mistake occur by the banks, then there is going to be like a run on the bank, which means people will rush to the ATMs to take out their money, and some people will be left alone. They're going to be protest and all the stuff because on numbers on monitor screen you can see the numbers, but there is no cash behind that because